What if I told you that there are several tax credits in Canada related to disability that can help you reduce the income tax you have to pay? Now, a lot of people know about the disability tax credit because that is the main tax credit that is advertised by a lot of organizations, a lot of tax companies, by the government itself. But many people don't know about programs like the Canada Caregiver Credit, the Disability Supports Deduction, and the Home Modification Expense program. And so we're going to discuss those types of credits that can help you pay for a lot of expenses, whether it's for your own disability, if you're a caregiver, or if you're a homeowner that needs to modify your home. This video is meant for informational purposes only, and all things discussed are found from the official government website. So first, we're going to discuss the Canada Caregiver Credit. The Canada Caregiver Credit is a non-refundable tax credit that may help reduce the income tax of people supporting a spouse, partner, or dependent with a mental or physical infirmity. Now, if you're wondering what an infirmity is, it's basically a legal academic term for disability. It's basically saying if you are caring for somebody who has a either physical or mental disability, then you may be eligible for this tax credit. You may qualify if the person depends on you for basic needs like food, shelter, and clothing, and they are your spouse, common law partner, child, grandchild, parent, grandparent, sibling, aunt, uncle, niece, or nephew in eligible situations. So essentially, this program is meant for people who are caring for either a partner, whether they be common law spouse, or somebody who is in the family tree, whether it be, somebody who's older than you, somebody who's younger than you. I don't know how far they will allow the terms like aunt and uncle or niece and nephew, because obviously in some cultures, like my culture, I call people who are my parents' friends aunts and uncles, but they're not related to me in any biological way. So I don't know how much this program you have to be biologically related to the person you're caring for, or if it can be like somebody who's a step-parent or somebody who is a mother-in-law, father-in-law. It all depends on the situation, but the family kinship of what they define to be a family seems to be pretty broad. Depending on the person's age, relationship to you, income, and what other tax credits are claimed, you may be able to claim up to $2,687 or up to $8,601 on specific tax lines. So obviously, based on the website, you can claim this tax credit and claim other ones as well. You may not get the full amount of this tax credit if you're claiming other tax credits, but it depends on what other tax credits that you are applying for while simultaneously applying for this. But obviously, it's a good chunk of money. It can take maybe up to $1,000 off of your income tax, and so it's one of those things that's really important to have. You do not need to send documents when filing, but you should keep medical records or an approved disability tax credit certificate in case CRA asks for proof later. So again, this is a program that would be really great to have if you are a caregiver for a person with disabilities, especially for people who are caregiving for grandparents and anybody who's a senior with a disability. I see very, very few resources for caregivers of the senior community, especially people who caregive for somebody who has dementia, Alzheimer's, or other cognitive conditions who are seniors. It's very low going and it's very low resources out there. So programs like this really help in decreasing the financial burden that there is to be a caregiver for a person with disabilities. But again, it's great if you have the certification of being approved for the disability tax credit, because being approved for that program and proving that the person in your family or the person you're caregiving for has a diagnosed certified disability really does open a lot of doors. If you haven't seen my video about the disability tax credit, it's right here. I'll show you that you can, and also link it down to the bottom so you can check it out later. But it's a really great program to be approved for because it documents and it certifies the disability of the member in your family or for you yourself if you're applying for disability. It just opens so many doors. So next we're going to discuss the Disability Support Deduction. The Disability Support Deduction lets a person with a physical or mental impairment deduct certain eligible expenses that they paid so they could work, attend school, or do a grant-funded research. So similar to the Disability Tax Credit, this is a program that is meant for people with disabilities, but instead of like overall things that you have to pay for, this deduction helps specifically in areas of school or work or research and stuff. So it kind of goes into a specific category more than a broad category of the Disability Tax Credit. Again, if you haven't seen that video, I will link in the description, but you can see it right here. And it's really great to have because it might be something that you can, again, apply for while still applying and getting the deduction of the Disability Tax Credit. Only the person with a disability can claim this deduction if they pay the eligible expenses themselves and meet the CRA's impairment and purpose requirement. So unlike the Caregiver Credit, this is a credit specifically meant for the person with disability themselves. Nobody else around them, not even their spouse, can claim this, and it's specifically meant for them and for specifically areas of school, research, and work. Eligible costs can include disability-related devices, software, attendant care, intervening services, and other approved supports, with some items requiring prescription or medical certification. On the government website, which I will link below, it actually has like a list of things that you can claim in this deduction. But I really think it's awesome because, again, there's many places that don't really provide people with funding for attendant care. So if at least you can reduce it from the taxes that you pay each year, so that can help offset some of the costs, and especially with things that are possibly yearly expenses like attendant care. Some things are one-off expenses like software and certain disability-related services, but attendant care for people who have a permanent disability is like something that they need every single year. And so if you're in a part of Canada that doesn't have attendant support, or it's privatized, or if it's this, or if it's that, then you can at least claim the deductions of that from your tax credit and offset some of those costs. You cannot claim the same expenses twice as both a medical expense and a disability support deduction, and unused amounts cannot be carried forward to another year. Now, what they mean by a medical expense is that there's another category that you can claim medical expenses on your taxes as well, but it's separate from the disability support deduction. But a lot of them do have overriding or overlapping categories, and so you can't claim both. You can't claim both a medical expense and disability support for the same thing. It has to be one or the other. And there are things on both that don't overlap too. So having a look at both things and seeing whether or not that there are things that you purchase within that year that you can claim towards your taxes, and just reduce some of that income tax that people have to pay, because sometimes they be hefty and sometimes the returns that you get are very small and light, and so this can help increase the amount of return that you get. But it's obviously important to know that you can't move things that you haven't claimed in the past forward, or things that you haven't claimed this year into next year. Is very much dependent on year after year, and it's very much dependent on what program that is specific for, whether if it's specific for medical expenses or if it's specific for the disability support deduction. So next we're going to discuss the Home Accessibility Tax Credit. The Home Accessibility Tax Credit is a non-refundable tax credit for eligible renovations or alteration expenses that help qualify a person's access, move around, or function more safely in their home. So obviously this program is meant for people who own their own home, or if the home that they're living in, that they are living with somebody that owns that home, because it's meant to help offset some of the costs that there is in modifying a home to meet your accessibility needs, especially for people who have become disabled through either age or injury or unexpected diagnoses. They may have a house that is more geared to an able-bodied function, but because of their sudden disability, they need to modify it for their own needs. You may be able to claim it if you are a qualified individual or an eligible individual making accessibility-related improvements to an eligible dwelling. I don't know what the difference between an eligible and a qualified individual is. I think that is something you're going to have to ask CRA. I'm not a tax accountant. I am a social worker. And so my knowledge of these phrasings sort of begin and end in there. But I think what they're trying to get at is that if you own the home and you have a disability, or if you are living with somebody who owns a home, I don't know if this extends to a landlord who was modifying for their tenant. It might. That is something you would have to ask CRA, but it does, I think, basically mean that you don't have to be the disabled person that owns the home that still qualifies, but you do have to discuss and see whether or not the person who does own the home is a eligible related or eligible adjacent person towards needing to get these resources to modify the home. Since 2022, you may claim eligible expenses of up to $20,000, which may provide a tax credit of up to $3,000. So obviously based on that, you can claim quite a bit on this program. You can claim up to $20,000 worth of expenses, but are you going to get all of that back in a tax credit or rebate or return or whatnot? No, you're going to get a fraction of that. But I mean, I think a little bit is better than nothing. Modifications on homes can be very expensive, depending on if you're eligible for funding in your area, or if you're just doing the whole cost by itself. It can really dig into your savings and deplete a lot of your savings. So $3,000 is not going to go like the furthest, especially if you have done up to $20,000 worth of renovations, but at least something is better than nothing. The expenses must be for qualifying renovations or goods that improve the accessibility, mobility, functionality, or safety within the home or the entrance to the home. So again, since this credit is meant to make your home more accessible, it has to be renovations that are geared towards that. It can't be things where it's meant to increase the value of the home. It's meant to increase the mobility and safety of the home. And so knowing those differences and knowing that it meets eligibility for increasing mobility and increasing safety, so that maybe there's less falls, maybe there's less accidents or things that could endanger people if they were in a home that's geared towards an able-bodied person rather than a person with a disability. And that's it for today's video. As always, all the programs discussed will be linked in the description. And if you have any questions, please don't hesitate to drop them in the comments. And also, don't forget to like, share, and subscribe. It really helps my channel grow. And watch some of these other videos that YouTube has recommended.